Hello again. I'm Jan Hatzius, Chief Economist and Head of Global Investment Research, and we're very, very pleased to welcome Dr. Chang-Yong Ri, Governor of the Bank of Korea and Chair of the BIS Committee on the Global Financial System. Many of you will know Governor Ri from his extensive international experience, previously as Director of the IMF's Asia Pacific Department, Chief Economist at the Asian Development Bank, and Vice Chairman of Korea's Financial Services Commission. Dr. Ri holds a PhD from Harvard and has taught at the University of Rochester and Seoul National University. So, Governor Ri, thank you for joining us today. Let me begin with a few questions to frame the discussion, and hopefully we'll have time for some audience questions, which I will track on the iPad here. But let's talk about the regional implications of the global economic outlook. Global policymaking has become very challenging, and of course it's always been challenging, but it's become more complex by rapid technological transformation and also geopolitics. If you had to identify the three global forces that matter most for the regional outlook in Korea and East Asia, what do you think? What would you put at the top of the list? Candidates, of course, which have been discussed here, include the AI boom, very relevant, of course, for Korea, rising tariff and trade risk, very much in the news again this week, China's excess capacity, or uncertainty around global monetary policy and US monetary policy. But I'd love to hear your perspective.
Thank you, Ian, and thanks very much for inviting me. Before I talk, let me congratulate you for the Lawrence Klein Award again for three consecutive times. It's quite impressive. And you asked me the three key points that make me sleep and cannot sleep during the night. I can say that from a Korean perspective, but from a regional perspective, there are a few things. One is, I think global growth probably will remain mediocre around 3.3% this year. But our focus really whether the U.S. exceptionalism, whether U.S. growth can be as good as the last year, given the rising political, geopolitical risk. Actually, if you remember this Liberation Day last year, the shock that we experienced, I thought that the global risk will probably subsume thereafter. But if you look at what's happening in Venezuela, Greenland, Iran, and all others, and the continued trade dispute, whether the U.S. economy and the global economy will remain resilient like last year is a big question, because U.S. is our big partner. And then the second point is that I see definitely there is a more monetary policy diversion among the major central bank. As you can see, Japan and the U.S. and Korea also, but the European ECB too. And it has a quite important implication for the FX volatility, as we've seen this week, right? And then these days, more and more FX dynamics is not driven by the economic fundamentals, but many political elements also play an important role. So for a small country, open economy like us, what is the future direction of the monetary policy in the world, especially U.S., and how the exchange rate dynamics will change is a second important factor. With regard that, I think this year, we are talking, today is especially relevant because dollar start to be weakened significantly. And in BIS, we talk a lot about the fiscal sustainability issue and what it has implied about the government debt as a safe asset status, how it is going to be changing, especially given the lot of non-bank financial institutions participation, especially hedge fund participation in a government bond market, repo market, for example. and how this will evolve together with the monetary policy change. That's a kind of a second risk. And then third risk is more like, as you mentioned, technological development in digital economy, AI, and stable coins, and how this will evolve, and especially the possibility for the asset price correction, especially AI-related stocks. In central bank's point of view, it has increased. But when I talk to many of the market participants, they still believe there's more room to go. But as a regulator and as a central bank governor, we have a lot of room to be concerned.
And certainly in an environment in which the general view is very positive, as a regulator and as a policymaker, you're always going to be more focused on the potential downside risks.
Yeah.
I think that's very natural. Perhaps if you'd like to offer some more perspectives on the exchange rate developments, in particular, the recent volatility in the Korean won. A lot of investors at this conference and elsewhere have been very focused on the Japanese yen and the Korean won. And what's your take on the recent ups and downs of the Korean won in particular?
I had a good sleep yesterday night. If I look back the last 2 months, after November, I was really puzzled why Korean won started to depreciate a lot more than I thought reasonable. Because by comparing with the dollar index, we start to be decoupled from October and November. And the amount of, look, as a central bank governor, I do not want to talk about the level of the exchange in general, but about 1480 level of the exchange rate at the time, considering our historically high current account, it's kind of hard to justify. And some people, around that time, our currency moved together with the yen, but still considering that there was a significant depreciation. And one interesting new fact in Korea was that we see the divergence between the funding market, dollar funding market, which is repo market, swap markets versus spot market. In our FX swap market, the dollar price was the lowest historically. On the other hand, in spot market, we have a highest, the price in dollar. So it's our first time we experienced these things. So we expressed the situation as a kind of scarcity in plenty. So there are a lot of dollar in Korean FX market because our export is high, and all these things. But people doesn't want to sell this dollar into spot market, so the exchange rate goes up, and we find that. Not international investors, but mostly domestic investors, including individuals and national pension fund and institutional investors, still believe that Korea won will depreciate further. So it's very hard for us to fight for this expectation. And now, I think recently, thanks to the, I don't know whether it's a joint effort or not, but this rate check by US and Japan, now our Korean exchange rate also stabilized quite a lot. And yesterday, together with the remark of Mr. Trump, it further down. So now it's around the 1430 around ranges. Mm-hmm. So I think that makes me a little bit more comfortable. But I think what drove our exchange rate depreciation sharply compared with our fundamental in October and November is there are a lot of global factors, but domestic factors matter too. I can mention one domestic factor is a continuous expansion of overseas investment by the National Pension Fund. Mm-hmm. Our National Pension Fund become a dominant player in our FX market. They continue to bring the money out, and their investment now become quite big compared with the size of our FX market. And then with that, it generates a continued expectation that Korean won will depreciate. And that expectation make individual investors prefer to invest overseas again. So because the news of yen intervention, it was not well known, but there was a very important announcement by the National Pension Fund a couple of days ago, and we have a lot of discussion about the macroeconomic impact of national pension fund overseas investment. And now they understand that their size is too big to be ignored. So they announced that this year, they will definitely start the strategic hedging, so reduce their dollar demand in our spot market. And also they announced that they will reduce the size of the overseas investment in this year by half. So which means at least there will be less, there will be $20 billion less demand in the spot market because of this movement. And we are now, but that's for 2026. But we are now, with the government, continue to discuss with National Pension Fund how we're going to reform and change this current system. And we call it a new framework. So we will discuss with them. Currently, their hedging ratio objective is 0%. And as is my personal opinion, as an economist, I think it doesn't make sense. And they have to really increase the hedge ratio. And then also, if we look at our derivative market size, they cannot just rely on the swap with the central bank as the only instrument for the hedging. So they should have more other instrument for kind of other alternative source of getting the dollar funding. It's already news. We are talking about whether we will allow the National Pension Fund to issue dollar-denominated debt so that it can be, from ALM perspective, it can be a natural hedge. So we will discuss what is optimal hedge ratio with them. And then also we will discuss with them what is the proper, foreign investment proportions. So together with that, it will be decided within 3 to 6 months, and then there will be some change in the structure of our FX market.
Thank you, Governor. Let's turn to the growth outlook for Korea. And if you take your baseline global growth scenario, how do you see Korea's growth evolving from here? Last year, growth came in at only around 1%, well below potential, but the economy does appear to be regaining some momentum, and the Monetary Policy Committee has also indicated modest upside risk to the current 1.8% growth forecast for this year. What are the key drivers behind this expected recovery? Is trade with China still as important a driver for Korea's growth as in the past? And if you look ahead, what are the biggest risks to the growth forecast for Korea, both on the upside and the downside, that might warrant a policy response as you go through this year?
Yeah. Last year was, I don't know to recall, was really exceptional. In the beginning and beginning of the year, we suffered significantly from unnecessary and declaration of martial law. It has increased our political risk quite significantly, and we had a negative growth in the first quarter and almost 0% growth in the first half. So 1% number is, we are very lucky to have a 1% number because after this unexpected political shock, second half, actually our export really performed very well, and then we could manage to have a 1%, but it was not an easy year because of this political instability. So we will recover from that shock this year, and then most important driver this year is definitely our export in semiconductor, defense industry, and the autos, and shipbuilding. So and especially semi-industry and the AI-related export is quite strong. We are expecting 1.8% growth rate, but at this moment, I think there is some upside risk in our forecast. And on the other, having said that, I think definitely our growth is K-shaped. If we exclude these sectors that I just mentioned, especially IT sectors, our growth rate will be around 1.4%, definitely because of the still unrecovered construction sector, which is now not very good. So but it's K-shaped, growth is all over the world. But you mentioned whether the trade with China is one of the factors which drive our growth. Unfortunately, no longer. Okay. And the Korea economy is decoupled already a long time before this trade tension happens, not because of any geopolitical tension, but China and Korea share the similar industry to compete, and China's competitiveness increased quite significantly. So naturally, from 10 years ago, 5 years ago, our business has withdrawn from China. So now China used to be our largest export market, and we have a lot of current account surplus, but China, now we have a current account deficit with respect to China. Still large, one of the largest trading partner, but China is no longer our growth pole for our growth. Actually, the U.S. become much more important, and it's Europe and other Asia become an important growth pole at this moment.
Okay. That's very helpful. Maybe turn to the inflation side. The Bank of Korea forecast for inflation is stable at around 2%. What are the main forces that are keeping inflation so stable, even though in many other economies we've had much bigger fluctuations in the inflation path?
Do you mind if I make okay, I promote myself. I'm just kidding. I think Bank of Korea is one of the central banks who started to hike the interest rate earlier. So we achieved inflation stability a lot earlier than others. So we achieved about 2% inflation in year 2023, long before others achieved it. And then at this moment, last year, our inflation didn't increase very much, unluckily because of this low growth rate due to political instability. This year, despite the quite a significant depreciation of our currency, still our inflation is about, it was 2.3, but now it's going down to 2.2, and still slightly above 2%, simply because of despite the depreciation, oil price remain low. That helps a lot. So this year we are focusing that our inflation will remain 2.1% despite the economic recovery to the 1.8 or even higher. One risk factor is that if the exchange rate remains around 14.70, 80 for long, I probably have to add a few more points to our inflation rate. But luckily, you can see that our exchange rate is going down. So I'm confident that we will keep the inflation around 2% this year.
Congratulations on that achievement. I did want to come back to the K-shaped recovery that you touched on. The tech sector really benefiting from the AI boom and from the demand from the United States, while the traditional heavy industries have been more under pressure, also related to the changing trade patterns with China. And domestic consumption, I think, is still pretty subdued, partly related to the demographic headwinds and limited spillovers from the strength in the tech sector. This is a difficult topic for central banks because you have basically one policy instrument, and there is a limited amount that you can do to help or restrain particular sectors in the economy. But how does that influence your monetary policy? Does it play a role at all? And if so, what are you doing to address it?
Yeah, this is a dilemma. Many people blame central bank on this issue too, because it's not just the growth, but even though I mentioned that we were very successful in achieving the inflation stability, people do not believe it because of the past accumulated inflation. Cost of living is also increasing very high, even though we are better than the United States. But people complain about the high cost of living, and they do not differentiate inflation rate versus price level.
Right.
So with the K-shaped recovery, together with high cost of living, they blame central bank, and also they ask, we have to do something more. But from a central bank point of view, I don't think we have any tool to address this issue. For example, if low-income people suffer, if I reduce the interest rate, okay, and not irrespective of the implication for price and other things, lion's share of our interest benefit of our interest cut will go to the rich people and the large corporation because they borrowed more. So actually, it may seems to ease some of the constraint by the poor people, but the lion's share of the benefit will go there. So I think interest rate is not a good instrument to address this K-shaped recovery. Definitely, fiscal policy and other institutional reform has to address this issue. But politically, we are definitely under pressure.
This is an issue that many central banks face, that the immediate focus is always on interest rate cuts benefiting financial markets, working via financial conditions, and therefore benefiting the wealthy more than poorer people. Although, ultimately, if you keep the economy near full employment, those benefits, which are perhaps a little bit more indirect than the ultimate result of your policy, that's actually more important for lower and middle income people whose fortunes are much more tied to the achievement of full employment. This is a debate, of course, that we've had in the United States for decades now, certainly since the global financial crisis. But it's a difficult communication issue for central banks everywhere.
Yeah, sure. And if our output gap is very big, and if there's a lot of unemployment, we probably have some tools, some option for cutting the interest rate. But this situation is not like that. And then just addressing this K-shaped economy with the interest instrument is not a good idea, in my opinion.
I have a related question on the household sector, and in particular the household debt levels and household leverage, which in Korea remain quite high, as they have been for a while, comparable really to levels seen in parts of Europe and elsewhere in the region. How central has household deleveraging been for your monetary policy considerations, and what progress have you observed during the time of your governorship? And if you look at your experience, not just in Korea, but also from your time at the IMF and Korea's financial regulatory system, how do you think about the optimal policy mix? You want to balance counter-cyclical monetary policy with really the structural measures to reduce the economy's vulnerability to financial imbalances, and ultimately you want to support more sustainable household deleveraging. What's your approach to that?
First of all, from a Bank of Korea's perspective, our primary key goal is price stability. And then once you achieve the price stability, our secondary tiered mandate is financial stability in consideration of the sound economic development in national sound economic development. So financial stability, including household debt, real estate, exchange rate, all this is our secondary mandate. In that sense, long time before I became a governor, when I was director of Asia Pacific Department at the IMF, one of the kind of warning from the IMF to the Korean government was that household debt over GDP ratio was kind of high in Korea, and it was not a financial stability issue because most of the household debt is related with real estate investment. So it's in some sense well collateralized. But household debt over GDP ratio, when I became a governor, was 98% of GDP, which is one of the top two in the world, and that top four in the world. And there's a lot of study which shows that with that high level, even if we do not have a financial stability risk, that is becoming a constraint for the growth because the consumption will be reduced, and So we really want to address this issue. And luckily, in the last 3 years, our household debt over GDP ratio declined from 98% of GDP to now 89% of GDP. And with the government, we have a goal to continue to reduce that ratio to 80% of GDP. We are not rushing it because when I look at the deleveraging experience over the world, it usually takes 20 years to achieve that kind of reduction. Because if we rush to cut the household debt level rapidly, it has implication for the financial stability and also the accessibility of the housing, etc.
Right.
But we want to make this denominator getting bigger while we are keeping the numerator in certain proportions, so we can continue to reduce the household debt ratio. And we use macroprudential approaches. So, for example, like last October, in August is a good example. Our inflation rate is quite stable, but we see that the real estate prices around the metropolitan area is increasing fast, and we introduce macroprudentials and lending regulations. And also we find that the government subsidy to the low-income people actually is become one of the drivers of the housing price itself, because when house price goes up, politically there's a demand push to provide more loan to the low-income countries. That drive the housing prices, and then we have to increase the subsidy again. So we start to reduce the government subsidy for this housing program.
Yeah.
So we do many institutional effort, and I hope that we can continue to make this ratio go down further.
So you're aiming for a continued decline, and what are you seeing in terms of other measures of credit quality? I mean, debt levels, that's always one aspect, of course, but then you have a lot of information through the regulatory system, through your bank oversight of what's happening with delinquencies and charge-offs.
No.
Are you seeing the trend? Are you seeing concerning trends there?
No, actually, for real estate, I think real estate project financing, we see some concern that you mentioned. Mm-hmm. But the banks, usually the banks' household, loans for this household debt related with housing, purchase of house. Usually, rich people borrow more.
Right.
So we don't see any default rate is increasing. And actually, issue is more like a social harmony, because we are now introducing the new macro prudential measure, which basically limit the total amount of the borrowing from the bank to purchase housing. Mm-hmm. And the rich people can use their other source of the money.
Right.
So they can still invest in metropolitan area, but the youngsters and the poor people is definitely restricted in the leveraged buying of the house, and they complain. So I think government has to come up with some other solutions, such as providing the more like public housing for the renting, all kind of things. But it's kind of, I know there is a cost, but if we continue to do these things, this will increase the housing price in a metropolitan area. Even though it's not a macro financial stability issue, that will definitely hamper the social cohesion. Mm-hmm. And I think one of the reasons why, except the recent period, one of the reasons why Korea has a significant Korea discount in our stock market is because compared with the housing market, compared with the stock market, leverage can be much easier in housing, rate of return is much higher, tax is much lower, so people move to the housing market. And I think we have to really change this pattern so that we can use our limited capital into more productive use rather than keep on buying the real estate.
Right. Thank you for those perspectives. Let's move to another topic, namely the inclusion of Korean sovereign debt in the World Government Bond Index. Congratulations again on that inclusion. It really is a big milestone for Korea and a sign of how much progress has been made in modernizing Korea's capital markets. The inclusion starts in April and runs through November, so it's coming up very soon. And I'd be interested if you could walk us through the most challenging issues that had to be addressed during the preparation process. What did ministries and the Bank of Korea really have to solve for to get that green light? And as we head into the actual implementation, what steps are already in place to make sure that the transition goes smoothly? And maybe finally, how do you expect the inclusion to influence foreign inflows into Korea's bond market and the FX market over the coming months? And how does that interact with some of your thoughts on the exchange rate and the financial markets more broadly.
Yeah, as for the WGBI inclusion, I'm very glad that we finally at the last stage of seeing this is happening in April. And actually, we were listed places that the WGBI watch list in 2022. And the issue was how we're going to improve the accessibility of the foreign investors to our bond market. And we did a lot of reform. For example, like we extend our trading hours of our onshore FX market to 2 a.m. in the morning so far. And then we're going to extend it for 24 hours trading hours by June, or I think it's by July. Mm-hmm. So, and then also we allow the omnibus account for bond trading, and we allow the tax exempt for the foreign investors for our Korea government bond and monetary stabilization bond. And now we are allowing the licensed registered foreign institutions to access onshore our FX market directly. So they can now from soon, they can trade, deposit, and fund Korean won directly from offshore through as long as they are the registered foreign investors. And to help that, Bank of Korea will establish our BOK wire system for 24 hours too by July or even earlier. So we will do this kind of, in March, I think that with the foreign institutions, we'll do the testing period so that we can be ready for the April inclusion. So some of your institutions will probably join this testing pilots in March. And in general, I think the philosophy that we are taking is that we want to get rid of every restrictions for the foreign investors, as long as they become a registered financial institution so that they can access our FX market freely. On the other hand, for our own domestic regions, we are now want to keep some constraint, capital flow management measures for the domestic resident for various regions. But now we are examining whether this is technically feasible. So then we may consider whether we have to open our market for the resident also down the road. But for the time being, if you have any issue for accessing Korean FX market and Korea capital market, if you can send an email to me or our institution, we are willing to address that issue. And we are doing our best to open our market in preparation for the WGBI list.
Okay, put that on your list with those of you who are becoming more engaged in that market. And I want to ask a related question about the equity market. Mm-hmm. And alongside the bond market upgrade, the Korean government has laid out a roadmap for elevating Korea's equity market to developed market status as well. A plan that includes Korean won internationalization. Could you maybe explain the motivation behind this initiative and how you see the timeline toward international currency status and what challenges remain, and also what that implies for your monetary policy role?
I think for MSCI inclusion after the WGBI, I think current President Lee is very eager to see that the Korea stock price to be included in MSCI index in his term. So there is a definitely very strong political will to do so. Previously, like WGBI, the issue that hindered our inclusion in MSCI index was FX market accessibility. So same issue. So we are addressing this issue. So we want to convince the MSCI committee that the recent progress that we are making. But different from bond market, there is one other issue about the MSCI inclusion, which is like our corporate governance issue. Because compared with other advanced economies, there is a kind of, the small investors' privileges and the right to, whether they can be enoughly protected. So, but I think under the current government, because the current government has a majority in the Congress, the president is really pushing this corporate governance issue. So I think one of the reasons why our stock price increase is definitely due to because of the AI boom, but also we have seen in the last couple of months some significant improvement of the corporate governance and the transparency issues. And then this party will continue to effort to improve this corporate governance issue. So I think there is a room. So once these two issues are resolved, we will try to convince the MSCI committee whether we are ready. One bottleneck is the issue that I just mentioned, whether we're going to allow the full convertibility or full liberalization even for the domestic resident. But that issue is still remains, but we will try to convince the MSCI committee that at least for the foreign investors, there's no restrictions. So we'll see how it goes. If that happens, it has a lot of implication for the Bank of Korea. So we will see more capital flows in and out in our market. That make FX stability issue more acute. But in my opinion, I may be but I was probably trained too much in overseas. But I'm one of the believer of the benefit of the flexible exchange rate regime. So flexible exchange rate has a lot of benefit as a sharp observer. So if there's more flow and we make our exchange rate more flexible, I think we can manage it. At the same time, I think that if we get into the WGBI as well as MSCI index, I really hope that we can see the change of the investors, I won't say quality, but the composition. So instead of a lot of short-term investors, if we are including MSCI index, we really hope that there's more investment from the institutional investors who invest in Korea for the longer-run perspective, and that probably will stabilize our FX market. And in my opinion, I think this is a good time to do this effort because AI is really key word in the probably down the road for the next couple of years in driving the stock prices. And in Korea, we have some sense benefit in the sense that who's going to become a final winner of the AI industry, whether it's Google, OpenAI, or Microsoft, they need the semiconductor. Right. So in Korea, not only we have AI software companies, but we are the producer of the high-end chips. So who's going to be a final winner, and there is maybe a price correction of some of the leading AI companies, still our semiconductor export needed for the AI investment will be high for the next couple of years. So our stock market has some merit to induce the more investment in Korea. So probably this may be a good opportunity for us to promote our stock price index to be included in MSCI.
Yeah, you're in a good spot in that sense, and it may be a good time in the cycle. Lastly, I had a question about monetary policy transmission, which I'd love to hear more about. Really, your ongoing efforts to fine-tune Korea's monetary policy transmission, in particular the shift from the 3-month CD rate to COFR as the key benchmark for monetary policy. How is progress on expanding the OMO market to non-financial institutions and moving from CD fixing to COFR going? And when do you see that overall transition being completed?
I'm very glad that I have this opportunity to explain the recent progress of introducing COFA rate as a reference rate in our short-term financial instrument. And I want to really make it, this is my legacy, my term. So you know that the CD has been a key reference rate for the short-term financial instrument for a long time. But CD rate has a lot of problems. First of all, it's not transaction-based, it's not risk-free, and it's not transparent, and many problems. But there has been many attempts to change this reference rate from CD to COFA in the past. But for various reasons, it was delayed. And because it's very hard to make people to change this kind of convention they used to have. But in the last 2 years, we really worked very hard. So we changed a lot of technical foundation for COPA adoption. And then we try to expand the COPA-related instrument market share. For example, we mandated our bank to have more than 10% of their COPA OIS transactions trade. And then also when they issue the FRN, we ask them to issue at least 10% of new issuance of FRN to be COPA linked. And so we also introduced central clearing mechanism for the COPA OIS in the last 2 years. And I think we are ready to move into the final stages. So we are at the final stages, and I talked to the financial regulator who has a legal mandate to do so. They agree that by this June, they will announce the final the plan to phase out CD with some time. You need some time to phase them out. I guess that they will probably give you the 2 to 3 years to phase out the current product, which is linked to the CD instead of the COFA. But I'm sure that with the announcement, which will be done by June, I think Korea will move from a CD to the COFA rate. And that is our plan. But you mentioned also the non-bank financial institution inclusion in our open market operation. That is a slightly different issue. And we allowed more expansion of the counterparts that we do with the open market operation with us. So we are including some of the asset managers and the non-bank financial institution to be listed as our counterpart for our open market operation. And then we also expand some of the eligible collaterals from them. The main reason is that after the Silicon Valley Bank accident, we see that the speed of the bank run can be quite fast in a digital economy. Mm-hmm. So given the size of the non-bank financial institution, we probably have to be a land of last resort if that happens. So in preparation for that, we opened the list of our counterpart in open market operation.
That concludes our discussion. Please join me in thanking Governor Rhee for his very insightful remarks and for speaking at our conference. Thank you so much. It was a real pleasure.
Thank you.